All right, let's dive right in. Today on Talk Tickers, we're breaking down the Q2 2025 earnings call from payment processor Repay Holdings. That's ticker RPAY.
So here's the big puzzle. Repay Holdings drops this bombshell of a number, a loss of $1.15 per share. You'd expect the stock to get hammered, right? But it barely moved. So what in the world is going on here? That's what we're going to unpack.
Okay, the whole answer really comes down to this tale of two very different earnings figures. You have to look past the headline to see what's really happening with the business. So first up, you've got the official by-the-book GAAP number. And whoa, it's a loss of $1.15 per share. I mean, that's not just a miss, that's a huge miss, especially when analysts were actually expecting a profit.
But then, wait a minute. You look at the adjusted number, the non-GAAP figure, and it's a completely different story. It's a profit of 20 cents. And get this, that number was pretty much exactly what Wall Street was looking for. So how can both of these be true?
Well, this is the key right here. The difference is all about what's included. That big, ugly GAAP loss, it was almost entirely caused by a massive $104 million goodwill impairment. Now, that's a non-cash charge. It's basically an accounting move, like tidying up the books. It's not cash walking out the door. So once you pull that one-time item out, poof, you get to that 20-cent profit, which, gives you a much better picture of how the actual day-to-day business is doing.
And this table just lays it all out perfectly. Look at this. Revenue, a beat, $75.6 million versus the $73.6 expected. Adjusted EPS, right in line. The only blemish was that GAAP number, and we know why now. So when you look at the actual operations of the company, it was a pretty solid quarter.
All right, so we've put the numbers in their proper context. Now let's shift gears and talk about the story management is telling. What's their plan to get this thing growing again?
The CEO, John Morris, he really set the tone with this quote. The whole message of the call was, hey, we're on the right track. They're positioning this quarter not as a standalone thing, but as a crucial step towards getting growth back into high gear later this year.
And to back this story up, they did something interesting. They talked about normalized gross profit. Now, the number on the page showed a 2% drop from last year, but management said, hold on, you have to remember a couple of things. They had some old clients roll off, and they're comparing against a year with a ton of political ad spending. If you pull those headwinds out of the equation, they say the business actually grew in the single digits. It's their way of saying the core is healthier than it looks.
And they didn't just talk in generalities. They gave a very specific game plan for the second half of the year. Step 1 for Q3 is to show that normalized growth is ticking up from Q2. Then, Step 2 in Q4, they're aiming to really hit the gas and accelerate to high single-digit growth. And all the while, Step 3, they're focused on turning that profit into actual cash, pushing free cash flow conversion over 60%. It's a classic, don't just trust us, watch us message to the market.
So you've got this weird mix of a big paper loss, but a decent operating quarter and a promise of better things to come. How did the market react? Let's circle all the way back to that question we started with.
Well, the reaction was basically a shrug. I mean, the stock popped a bit during the day, up about 4%. But then after the bell, once everyone really dug into the report, it gave some of that back. So no one was panicking and dumping the stock, but nobody was rushing to buy it either. It was kind of like the market just gave it a cautious nod and said, okay, we hear you, now prove it.
And that stock price action really mirrors what we're hearing from analysts. The general vibe is what you'd call cautiously constructive. Basically, Wall Street is saying, look, we love that you're generating a lot of cash, that's great. But this whole story about accelerating in Q4, we're going to need to see it to believe it.
Okay, that brings us to our favorite part of the show, the next call. This is where we give you our verdict and a potential trade idea based on everything we've just heard. First things first, what do we mean by market perform? It's simple. It just means we think the stock will probably do about as well as the broader market, say the S&P 500, over the next 12 months. No better, no worse.
So with that, our official rating for Repay is market perform. And here's why. On the one hand, that free cash flow is fantastic. Turning 71% of their earnings into cold hard cash is a huge positive. That's the bull case right there. But on the other hand, so much of the story now hinges on them delivering that growth acceleration in the second half of the year. That's a big promise, and there's a lot of risk they might not hit it. So for now, we're staying on the sidelines.
But if you're looking for an idea, here's an interesting one. Think about a pair trade. You'd go long on Repay while at the same time shorting a handful of other fintech companies that aren't as good at generating cash. The whole idea here is a bet on quality. You're betting that Repay's strong cash flow is going to be a huge advantage, especially with some debt coming due in 2026. It's a way to bet that their financial strength will make them stand out from the crowd.
All right, and before we wrap up, you know the drill. We have to get to the disclaimer.
And of course, remember, this is not financial advice.